All right, let's talk about a big one for the CMA exam, revenue recognition. There are some topics that are just guaranteed to show up, and this one, it's pretty much at the top of the list. It's a huge topic, it's heavily weighted, and honestly, you've got to nail it. So in this explainer, we are going to break down the entire 5-step model and give you a super clear framework to handle any question the exam throws at you. This question really gets to the heart of it all. Before the current standard, things were a mess. It was kind of the Wild West of accounting. You had different rules for software, different rules for construction, you name it. It was confusing. So regulators wanted to answer this one simple question in a way that worked for everybody, everywhere. And this is the solution they came up with. One single, unified 5-step model to rule them all. It completely replaced all those old, complicated, industry-specific rules. For us, this is the bedrock. This is what the CMA exam is going to test you on, and it's exactly what we're going to master together. Okay, before we dive into the steps, let's just zoom out for a second. It's so important to get this core principle down because everything else flows from it. If you remember nothing else, remember these two things. 1, the transfer of goods or services, and 2, the payment the company expects to receive. It really just boils down to when does the customer get control and for how much money. That's it. So here it is, our roadmap for today. The 5 steps in order. And you got to do them in order, no skipping ahead. I want you to think of it like building a house. You can't just start putting up the walls, right? You have to lay a solid foundation first. For us, steps 1 and 2 are that critical foundation. So let's pour that foundation. These first 2 steps are all about getting the setup right. We are not even touching the numbers yet. This is about defining the agreement and its parts. And listen, it is so important to get this part right, because if you mess up here, the whole thing falls apart later. Step 1, identify the contract. Now, I know what you're thinking. Well, of course there's a contract, but for accounting purposes, it has to be a valid agreement. And here's the kicker, the part the exam loves to test, you have to believe that collection is probable. Bottom line, if you don't actually expect to get paid, you can't recognize any revenue, period. It's a hard stop. All right, on to step 2, identifying the performance obligations, or POs as we usually call them. This is all about looking at the contract and breaking it down into every single distinct promise you made to the customer. Think of it like unbundling the deal. Each of those promises becomes its own little unit that we're going to have to value later on. So what does distinct actually mean? Let's make this super simple. If you go buy a cup of coffee, that's it. One promise, delivered right there. That's a single performance obligation. But what if you buy a computer that comes bundled with a 2-year service warranty? Now we're talking. You're not just getting a physical laptop. You're also getting a promise of service for the next 2 years. Those are 2 separate, distinct promises. One PO for the computer, one PO for the warranty, and we have to account for them separately. Okay, our foundation is solid. We know we have a valid contract, and we've broken out all the distinct promises. Now we can start talking about money. Step 3 is all about figuring out the total price tag for the entire deal, what we call the transaction price. Now, you might think the price is just, the price on the invoice, but it's often way more complicated than that. Of course, you've got your fixed amount, the sticker price, but you also have to think about things like performance bonuses or late penalties, or maybe even getting paid in services instead of cash. And if there's a long payment term, you might even have to consider interest. Okay, lean in for this one, because the exam loves to ask about variable consideration. This is any part of the price that isn't set in stone. It can change based on what happens in the future. The classic example is a bonus for finishing a construction project early. So how do you account for money you might get? You have to estimate it using one of 2 methods, either the expected value, or if one outcome is way more likely than the others, the most likely amount. And now we move to step 4. And I want you to pay close attention, because this is a classic CMA moth trap where a lot of people lose points. We've got our total price from step 3, and we've got our separate promises, our POs, from step 2. Our job now is to slice up that total price and assign a piece to each of those individual promises. So let's pose the question. Let's go back to our computer and warranty example. Imagine we sell that bundle, the computer and the warranty, for a single price of $1,000. How in the world do you split that $1,000 between those 2 separate performance obligations? You can't just guess. The standard tells you exactly how to do it. The method you have to use is called the relative standalone selling price method. It sounds complex, but I promise it's pretty straightforward. Here's how it works. First, you figure out what each item would sell for all by itself. So our computer sells for $900 and the warranty for $300. Together, that's $1,200. Next, you find the percentage for each one. The computer is $900 of that $1,200 total, which is 75%. The warranty is the other 25%. And now the final step. You apply those same percentages to the actual bundle price of $1,000. So we allocate 75% of the $1,000 to the computer. That's $750. And the remaining 25%, or $250, gets allocated to the warranty. That's it. All right, take a deep breath. We've done the heavy lifting, we've identified everything, we've priced everything, we've allocated everything. Now we've reached the finish line. Step 5. This is the payoff. This is when we finally get to answer that question, when do we count the money? The single most important word in this final step is control. That's the trigger. You recognize revenue when, and only when, a performance obligation is satisfied, which means the customer has gained control of the good or service. So many people get this wrong and think it's about when you get the cash. Nope, it is not about the cash. It's about the transfer of control. Now, this transfer of control can happen in two main ways. It can be at a point in time, like buying that coffee. You order, they hand you the cup, boom, control has transferred instantly, revenue recognized. Or it can happen over time. Think about a Netflix subscription, right? You get the benefit of that service every single day of the month. Or a huge construction project that takes 3 years to build. In those cases, you recognize the revenue gradually, bit by bit, as you deliver the service. Now, here's a quick pro tip, just from me to you. This is a common exam curveball, the right of return. When customers can bring a product back for a refund, you can't just recognize all the sales revenue and cross your fingers. You have to actually estimate how much you expect to be returned, and you don't count that amount as revenue. Instead, you set it aside as a refund liability. You will definitely see this scenario on the exam, so keep an eye out for it. Okay, let's wrap this all up with a summary. This slide right here, this is your cheat sheet. Seriously, you should take a screenshot of this for your study notes. It boils the whole process down to the one key question you need to answer for each step. Step 1, is collection probable? Step 2, are the promises distinct? Step 3, did I include all the variable stuff? Step 4, did I allocate using the standalone prices? And step 5, when did control transfer? If you can answer these 5 questions confidently, you're going to be in fantastic shape for this topic. So there you have it, the whole 5-step framework. But look, knowing the theory is the first step. The real learning happens when you start applying it. That step 4 allocation math we did is one of the most important problems you'll face. Now that you have the tools, are you ready to give it a try?